Good morning and welcome to Charting the Markets on Monday, the 5th of February 2024. On Friday of last week, we saw a much stronger than expected US employment data, with the non-farm payrolls basically coming in nearly twice as what was expected. And that led to rate cut expectations being pushed back from March to probably May or even June. And this has been also reinforced by an interview which was published in the US over the weekend with Jerome Powell, in which he also said that Americans should wait for interest rates to be cut, and that cut might not happen in March, as the Fed wants to make sure that the data is confirming that the US economy is not overheating. And we saw very, very strong employment growth in the US. We saw the 37th straight month of gains in employment in the US. And on the back of that, we also saw US equity indices rising to new record highs, with the S&P 500, for example, coming very close to its psychological 5,000 mark. Now, in China, we are seeing the opposite. The 10-year bond yield is now trading below levels last seen at the pandemic low. We've also had the Chinese equity indices continuing to fall. They then recuperated slightly, but still ended up in the red as the Chinese Securities Regulatory Commission tried to support local stock markets. And as services growth slowed in China, we saw the Caixin China PMI dropping to 52.7 in January compared to 52.9 in December. But it did stay in expansionary territory, that is to say above the 50 mark for its 13th straight month. Now, with regards to data out today, after the Magnificent Seven have shown their earnings in the last few weeks, the earnings front is quietening down slightly, and also from the data front, now that the Fed and Bank of England and ECB rate decisions are out of the way, we will be focusing more on probably today's US ISM PMI data, as it will confirm, perhaps or not, the strong employment data we saw on Friday in the US. And this is out at 3 p.m. Later this afternoon. So let's begin by having a look at the FTSE 100. And we can see here that we're trading in a sideways trading range between 7,690 on this daily financial bet and 7,600 last week's low. And further sideways trading is currently taking shape here, not much really happening. What will be interesting to see is which way we break out of this sideways trading range, because a rise above the 7,690 high, and ideally also above the 7,702 high seen in mid-October of last year, would most likely take us back up again towards the September and also the December highs of last year between 7,747 and 69. Whereas a fall through the 7,600 low we saw last week may take us back down again towards the red line here, the 200-day simple moving average at 7,551, and also these highs going back to mid-November and early December between 7,543 and 35. But at the moment, it's really difficult to say in which direction we'll break out of. Because we had an upsurge since the mid-January lows. Probably there's a slight bias towards the upside, also because US markets continue to trade in all-time record highs, but it's only a very slight bias, as we may also perhaps decline against. We'll have to watch these levels closely, 7,690 on the upside and 7,600 on the downside. Now, in Germany, the picture is more rosy, as you can see here. The DAX 40 index, the German stock index, continues to rise. It's currently consolidating below its 17,020 high, its record high on this daily financial bet. And earlier this morning, retested its January to February uptrend line, but that acted as support. And as you can see here, we're heading back up again, as Germany sees its largest trade surplus since 2017, even though exports are falling more than expected, and even though the Eurozone producer price deflation deepened in December. So here we're heading back up again towards the mid-December high at 17,003, above which we've got all these highs going back to late January, and he's culminated at 17,020 on this daily financial bet. So short term, provided we stay above today's low at 16,856, further upside is likely to be seen with regards to the DAX 40 contract as well. And moving on to the US, you can see here that the S&P 500, as I've just mentioned, nearly reached the psychological 5,000 mark, around which I wouldn't be surprised if we were to see some sort of consolidation taking shape, simply because it's a big round number. Quite often financial markets do tend to consolidate in these sort of areas, and we've had a really, really good straight run up since October of last year. So perhaps we could see some sort of consolidation in the short term of the next few days. But for this to happen, we would have to perhaps outpace the high from last week at 4,976 and indeed reach the psychological 5,000 mark. So further upside short term is still in store. Support comes in around the high seen on Monday of last week and Tuesday of last week, around 4,932. And basically, as long as we stay above the last reaction low, that's to say the low from the 31st of January, last Wednesday's low at 4,842, the medium-term trend is still pointing higher with regards to the S&P 500. The strong unemployment data out of the US on Friday, non-farm payrolls, basically completely pushed back rate cut expectations by the Fed to probably May of this year instead of March of this year. And that has led to a strong upsurge in the US dollar, and the inverse of which you can see here on this daily euro-dollar chart. And here we can see that we tried to rally last week, but then failed along this resistance line below the orange line, the 55-day simple moving average, and formed this bearish engulfing pattern where this body of this candle, where the red bit here basically engulfed the previous green body of last Thursday, and that is bearish. And you can see here we are seeing some follow through to the downside, and are now testing the early November high, which together with the December low 107.24 should act as short-term support ahead of the next lower support band beginning here at the late October high at 106.95, going down to the mid-October high at 106.39. So these are the next support areas below 107.24, which may well be reached in the next few days. And here minor resistance comes in at last Monday's low at 107.96. And above that, we've got the 200-day simple moving average here at red at 108.39. But I wouldn't be surprised if we don't hit that before we hit 107.24, as the US dollar continues to strengthen and as the euro-dollar exchange rate continues to be pushed lower. And the story is quite similar with regards to the British pound. Last week, we saw the Bank of England stick to its current stance, no policy change being made there. And here what we saw on the back of that strong US employment data and US yields rising once more, and not just US yields, I should say, also yields in Germany, for example, in France, in the Eurozone, not in China, as I've mentioned before. But basically, you can see here that we're heading now back down again. And we are currently in the process of slipping through this key support area going back to the end of December, which was made between 126.12 and 125.97. And as you can see here, we're now trading below there and are heading towards the red line here, the 200-day simple moving average at 125.65. So that's the next downside target. And below there, we've got the mid-December low at around 125 to look forward to, as we probably will be seeing further US dollar strength, which means that the currency pair here, the British pound against the US dollar, is being pushed down and will continue to do so as long as we stay below the orange line here, the 55-day simple moving average at 126.72. So as long as we're below there, again, we saw this bearish engulfing pattern we saw on the euro-dollar chart, also on the cable chart here, and that is negative and should lead us to further downside on this currency pair. Upside is being seen, though, with regards to the Chinese yuan. As you can see here, the US dollar appreciating against the yuan and taking us through this red line, the 200-day simple moving average, on the fact that basically the Chinese bond market, the 10-year yield on Chinese bonds, is now trading below the pandemic low, and also as services growth in China is slowing, even though it does remain in expansionary territory for its 13th straight month. But all of that basically hasn't really led to any appreciation in the won against the US dollar. So the US dollar taking the exchange rate to above the mid-December high at 720 and towards the 723.22 high seen in mid-January. So that's the next upside target for this currency pair. And what will be interesting to see is whether we can break through that resistance area at 723.22, in which case we could head to the September low at 723.92, and that is also important resistance. A move above there may well take us back up towards the August to October highs of last year, around 733 to 736. The stronger US dollar has had a negative impact on quite a few commodities, and we'll look at gold and silver in a moment. But before we do, I'd like to look at WTI, the price of Brent crude oil. And you can see here on the front month's futures contract that we have continued to slide. I mean, last week, despite some geopolitical tensions, we started to slide as the slowing economy in China is worrying investors about futures demand, and as there is ample supply with regards to crude oil. And you can see here that we are on track for our fourth consecutive day of declines, despite the heightened tension seen in the Middle East over the weekend. We are now testing the December to February downtrend line, and so far, earlier this morning, have held there at 71.74 on this front month futures contract. But a slip through there would not only take us back to the mid-January low at 70.61 and the psychological 70 area, but most likely also back down towards the December and early January lows between 69.41 and 67.94. So most likely further downside here to be seen with regards to the oil price, as there is ample supply and as demand concerns continue to weigh on this market. Now, resistance is seen around the orange line here, the 55-day simply moving average at 73.60. And as long as we stay below there, it's very likely that we're going to slide further in the next few days. Now, I mentioned the US dollar strength and the negative impact it's had on commodities. You can see that here on the gold price, where the gold price is now slipping through its long-term uptrend line, the one going back to October of last year. You can see here we've got this uptrend and we're currently breaking right through it. And it looks as if we could have a daily chart close below this uptrend line, which for me would indicate that further weakness is likely to be seen with regards to the gold price, taking us back to the late January low around $2,009 per troy ounce. And that incidentally ties in with the October high that we saw last year, and is close to the late November high of last year, $2,007, and also the January low, $2,002. So we're basically approaching this key support area between $2,009 and $2,002 per troy ounce. And if we were to slip through there over the next few days and also through the $2,000 mark, we could be heading back down again towards the mid-December low, 1,974, and also the 200-day simply moving average here in red at $1,967 per troy ounce. Now, this view will remain in play as long as we stay below the mid-January and current February highs between $2,062 and $2,065 per troy ounce. Now, last but not least, I'd also like to look at the silver price. And as you can see here, we've also failed at resistance. You've got this resistance line here at $23.32 last week. We toppled out, and that was marginally below the red line, the 200-day simply moving average at $23.44, which incidentally also didn't get quite hit in mid-January of this year when we ran it to $23.53. So basically, we've got a really good resistance area in this zone, and we're coming off it once again and heading back down again towards the lows seen back in mid-November and also in January between $21.93 and 89 cents. And we'll have to see whether we can hold there in the days ahead or not. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG. Have a lovely week.